Stocks may be the bread and butter of this channel, but some of those alternative assets sure can spice up your portfolio with, well, profits. Hold on to your seatbelts, folks. This is going to be a good one. I suspect what many of you may be thinking is, alternative assets, they sound complicated and maybe even risky. You may even think they are not for your portfolio. Well, it may come as a surprise, but you probably already have at least a little bit of exposure to alternative assets in your portfolio. No need to worry. We're going to break it down. So even if you're new to this, by the end of this video, you'll have a solid understanding of what alternative assets are, why they might be a great addition to your portfolio, and how to get started with them right away. Let's start by, defining exactly what we mean when we say alternative assets. Unlike the usual suspects, so stocks, bonds, and of course cash, alternative assets include things like real estate, private equity, commodities, cryptocurrencies, infrastructure, and even collectibles. Yes, collectibles. In fact, a mint copy of Action Comics #1, which is the debut of a certain person by the name of Superman, that can go for about $6 million USD. Holy banana bread. One selling point on alternative assets is that they don't typically move in sync with the stock market, which can help reduce your portfolio's overall risk. In addition to that, they can also offer higher returns. Of course, with great returns comes great responsibility. I couldn't resist that one, sorry. So let's take a look at some of these alternative assets. We will begin with real estate. I think most of us have a good grasp on the basics of investing in properties. And I am sure we are all aware of the current issues in the housing market. When it comes to gaining exposure to real estate, there are more than one way to achieve this. You can buy properties, which tend to go up in value, though I will caution that after the really huge amount of price growth we've seen during the pandemic, there could be a limited growth for a wee bit. Nonetheless, on a longer time frame, you are still looking at good appreciation of that investment. One exception, though. If you're looking into the condominium markets, especially in Toronto and Vancouver, there's not a lot of buyers for condos. So as a result, if you're buying a condo hoping to get some price appreciation on it, you may be waiting quite a while. You may actually see a little bit of depreciation on it initially. So definitely be wary. Be wary of the condo market. Make sure you do your due diligence before you sign any of the papers. You can also invest in REITs or real estate investment trusts. These are stocks that you can hold, in your portfolio. In a sense, they are non-alternative versions of an alternative asset. This is a good time for REITs, as they tend to increase in value during rate-cutting environments, which we are currently experiencing. In fact, we're at the beginning of a rate cut cycle that could last at least another year. So that's not too shabby when it comes to REITs. Moving on. Another alternative asset comes in the form of private equity and venture capital. These are investments in private companies that aren't listed on the stock exchange. Private equity involves buying into established companies, while venture capital is all about startups with high growth potential. Front Funder is one of Canada's big online private markets investing platform that allows regular investors to throw in some cash for startups and growth companies. It goes without saying, it is a high risk, high reward game. However, if you pick the right companies, the rewards can be supersized. But I always caution that just like penny stocks, these can be more of a gamble. And it's very likely that you're going to lose money unless you get lucky or you really, really do your due diligence. In the case of a company like Front Funder, they're going to do a lot of that due diligence for you and hopefully make better guesses on which ones they think are going to succeed. I will point out that I'm not sponsored in any way by Front Funder. Do your due diligence on this company before you even think about using them, for sure. Wealthsimple at one time had a venture fund, but they did eventually close that down, so you're not able to take advantage of that currently. Another and often popular alternative asset is, of course, the commodities markets. Think gold, silver, oil, or even agricultural products. Commodities are tangible assets that tend to perform well when inflation is on the rise or when the stock markets are volatile. Just look at the year gold and silver have had thus far. Pretty impressive. Getting into this market can involve buying commodities directly, like physical gold and silver, Or you can also indirectly get involved with commodity-based ETFs. Buying physical metals, that of course does come with liquidity issues as well as storage concerns, as you do want to protect your gold. Some commodities like, well, oil are more or less impractical to hold yourself. Not too many people have a shed filled up with barrels of West Texas Intermediate out in their backyard. Trust me, not a great idea. Luckily, we can gain that exposure, as I said, from ETFs. There are a lot of them covering most metals, liquids, and gosh, even gases that you may want to invest in. Commodities trading overall is very, very huge. Not just ETFs, you can also play futures as well. So there's a lot of options with commodities, and they're definitely an alternative asset you want some exposure to, in my opinion. Another hugely popular alternative asset is the world of cryptocurrencies. Crypto, particularly Bitcoin, has become more mainstream than ever. With the addition of spot Bitcoin ETFs in the US, more people than ever have some amount of exposure to crypto's flagship coin. Bitcoin began back in 2009, and since then, we have seen an explosion in the number of new coins. Everything from Ethereum, Solana, Cardano, XRP, and so many more. In fact, there's more than 14,000 coins out there. And despite all of the crazy number of coins that are out there, Bitcoin and to a lesser extent Ethereum have been taking center stage, and they're probably going to stay there. So why would you want to invest in cryptocurrencies? Well, crypto has shown some massive returns over the past decade. Early Bitcoin adopters, for example, have seen returns that blow traditional investments completely out of the water. Plus, crypto offers a level of independence and decentralization that appeals to many investors, especially in times of economic uncertainty. You can hold crypto yourself in a physical wallet, which many hardcore investors will insist is the only way to do it. However, you can still hold it in a soft wallet on an exchange, but that tends to come with a little more risk than the hardware wallet option. It can be minimal if you are holding it on a well-vetted exchange. So, for example, in Canada, both Wealthsimple and ShakePay are very, very good locations to hold your crypto. Even though I think they're both fantastic, once you start getting up there, as in more than $100,000 in crypto, you probably really want to consider a hardware wallet. In addition to simply holding crypto, there is an option to hold Bitcoin or Ethereum ETFs in your TFSA, or other accounts by using an ETF. There is a good selection of Bitcoin and Ethereum ETFs in Canada that will allow you to do that. In addition to those, there are even some covered call ETFs who add an income to your Bitcoin or Ethereum holdings. But once again, remember, if you're using covered calls, you are limiting your upside. With crypto, you can make a lot of money, but you have to be prepared for the volatility in the crypto markets and not letting the wider price swings shake you out of your profits. Moving on, that leaves us with infrastructure and collectibles. When it comes to infrastructure, this includes investments in essential services like energy, transportation, or water. These assets are typically less volatile and provide stable long-term returns. One great example is Brookfield Infrastructure Partners. This is a business that you can invest in to gain a broader exposure to infrastructure. In addition to Brookfield, I also praise those railway stocks, as they are very stable long term. When it comes to collectibles, it is not just comic books, as we also have fine wine, classic cars, fine arts, and even sports cards. The key here is to invest in what you know and love. If you're a wine enthusiast, for example, investing in high quality wines could not only bring you joy, but also a decent return over time. I will caution that with collectibles, they are perhaps the least liquid of all of the alternative assets we have looked at today. So why do you want some of these in your portfolio? For one, they can provide diversification. When the stock market is down, your alternative investments might be holding steady or even performing well. They also offer the potential for higher returns, especially if you're willing to take on more risk. But, and this is important, alternative assets aren't for everyone. They require a longer investment horizon. They're often less liquid, and they can be more complex to manage. That's why it's crucial to do your homework and perhaps start with a small allocation in your portfolio to perhaps test the waters. Speaking of smart investments, If you've been getting value from this channel, hitting that subscribe button is like adding a solid asset to your investment portfolio. It's a decision I don't think you're going to regret. If you are interested in any of these assets we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Harvest ETFs, and I will see you in the next video.